Please stay tuned after the conclusion of the podcast for additional important information.
Underpinning all of this is a change of the guard, if you like, where economics is no longer leading politics and social norms. It's actually starting to reverse the other way, where social norms are leading politics and politics are leading economics. And when you end up becoming effectively the tail that gets wagged by the dog, then you should expect the unexpected.
Hey everybody, welcome to another episode of Accrued Interest, PIMCO's podcast dedicated to serving financial advisors and their clients. As always, I'm your host, Greg Hall. I manage the wealth management business for PIMCO here in the United States. And with me today, I'm very fortunate. We've got Pramol Dhawan. Pramol's a member of PIMCO's investment committee. He leads our emerging market investment efforts globally. And he is the co-author, most importantly, of a recent piece that we published earlier this month. It's part of our PIMCO Perspectives series, which is a quarterly document that Pramol and our partner Marc Seidner put together to try to be thought-provoking, make sure that we're asking the tough questions of ourselves and giving you guys lots of things to think about. And the most recent piece was titled "Expect the Unexpected." So Pramol, thank you for taking the morning to spend with us and talk through the most recently published piece.
Yeah, thanks for having me, Greg.
Expect the Unexpected. Tell us about the piece and kind of the major thoughts behind it.
Yeah, great. Well, I think the big idea here is that uncertainty is not going to go away anytime soon. So sort of the call to investors is stop waiting for things to calm down. Things may not really calm down or never really calm down. You may have these rolling bouts of volatility and start positioning for it. I mean, the wonderful thing is that the markets are affording great opportunities for investors to position for it and get paid for that active positioning. Look, we think we're in a new era of policy right now and policy shocks. Governments are making big, unpredictable decisions very fast on trade, on spending, on regulation. Markets are reacting violently and then reversing also very violently. And this environment now is I think there's enough data now and enough occurrences to say that this is the new normal of policies, to borrow a PIMCO expression.
Yeah. To quote ourselves, right? Yeah. I mean, it's and you've been really thoughtful about the prospects of a new world order. And one factor you didn't mention, although I know it's central, to how you're thinking about the world right now, is geopolitical as well, right? I mean, we've had. Maybe in the piece you could actually just help us. You tick through some of the things that investors have had to contend with over the last 6 weeks of the new year. So what are some of the examples that you guys run through?
Yeah, I mean it's been a wild start to the new year. We've had the issue in Venezuela, political issue in Venezuela. We've spoken about capping credit card spending and interest on credit cards in the US at 10%. A various set of proposals on tariffs and adjusting tariffs up and then back down again. The issue with Greenland, whether the U.S. is going to look to take control of Greenland or not, as it may happen. And I think all of it sort of eluding. I mean, that's just from the U.S.'s perspective. Right. This is not meant to be a piece about the U.S. This is meant to be a piece about global mercantilism and global cross currents moving, if you like, away from a neoliberal order towards more of a mercantilist order. And
I'm trying to remember my Econ 101, mercantilism, global mercantilism. Let's get into that. How define that for me at least. Hopefully the listeners, are a little bit better educated than I am.
I think one can synthesize it as a movement away from a rules-based order towards a power-based order. Okay. A movement away from a positive sum world towards a zero-sum world. And a movement in terms of how capital is allocated from one which, under globalization, prioritizes an efficient movement of capital towards mercantilism, where capital is spent less efficiently because quite often it tends to be done for national security reasons.
Right.
And I think when we look at it in the playbook of mercantilism, many of the aforementioned factors that we spoke about, Greenland and Venezuela, they all sort of make sense within a mercantilist lens.
So it's, if I understand you correctly, it's sort of a simultaneous but they reflect each other, a breakdown in what we had really sort of come to appreciate as normal in the geopolitical sphere. So cooperation agreements and a higher degree of forbearance from us as the superpower to do those things that might be in our national interest, but they defy global norms, but now potentially more willing to kind of break some of those norms. And then on the economic front, a willingness to try things that also depart from norms, whether it's capping credit card interest rates or directing the GSEs to purchase mortgages, which happened also, in this very busy first quarter that we're having. So those two things kind of happening simultaneously, you view them as sort of just reflections of the same ideological shift.
Correct. And sort of underpinning all of this is a change of the guard, if you like, where economics is no longer leading politics and social norms. It's actually starting to reverse the other way, where social norms are leading politics and politics are leading economics. And when you end up becoming effectively the tail that gets wagged by the dog, then you should expect the unexpected.
Oh, that's you've tied that up perfectly, right? So it's we've moved, and I've heard Dan say this as well, Dan Ivison, our CIO. But this shift we've experienced over the last few years, where economics used to shift political outcomes. Now politics can determine economic outcomes to a degree, yeah. Right? I mean, we'll talk about bond vigilantes, and we'll talk about the power of institutions and the sturdiness of whether it's the dollar or the Fed and things like that. But certainly more so than we've experienced recently. You've got this first the politics happens, then the economic impact. All right, so all of this is happening, and we've got to digest this. From an investment perspective, I wanted to run through, because I just think it's interesting, amidst all of this volatility. So the last time that you and I spoke on the pod was July of the past year. And since then, we've had, I think, 3 rate cuts, so a total of 75 basis points. The 10-year was at 4.4 when we last spoke. It's at 4.1-ish this morning. The ag has done what we suggested it might do, which is essentially kind of earn its yield over that time period, about 5 odd percent, maybe a little bit more with those rate cuts adding to total return. Equity markets, interestingly, 7.5% since we last spoke, and we've been cautious on equity valuations, so we can talk about that. Emerging markets and global markets have outperformed the U.S. equity markets substantially since then. Another theme that you and Marc, had highlighted back then. And the dollar's more or less, kind of held even with where it was then, which I think reflects, some of the competing cross currents that we talk about with regard to the dollar. So I think, my question for you is when I look at some of these numbers that, if I describe that without having the prelude been all the volatility that is in the underlying economies and politics, you'd think, that seems like a pretty sanguine, pretty benign outcome, right?
Yeah.
So if we're expecting the unexpected, when can we expect the unexpected to matter in markets and investment strategy?
Well, I think it has mattered. It may not be volatility in a homogeneous manner,
right.
Well, like we saw in the global financial crisis, where cross-asset volatility converged to one and everything sort of sold off together. You're having these sort of rolling bouts of volatility.
Okay.
We've seen it in gold and precious metal markets, some in private credit markets, with the GSEs and buying of mortgages and agency mortgages as well. You're seeing rolling bouts of volatility, and I think that is really the new normal that we're going to see. And underpinning all of this is still pretty healthy U.S. economy, an economy that delivered 8% nominal growth in Q4, that's sort of trending towards 7% nominal growth Q1 of this year, really muted inflation, a Fed that's probably going to cut a couple more times this year. So we think the actual backdrop still is quite conducive for staying invested. But I do think that it has mattered, and what has mattered very fortunately for us is that bonds are doing exactly what they should be doing, which is hedging against equity volatility. Mm-hmm. And that correlation aspect has really held up.
Yeah.
And that's really...
And that was a little under assault coming out of 2022.
Yeah.
And then, I think you and I and others around here, we've heard the criticism that bonds and equities have been too positively correlated to hedge each other. You're seeing that relationship revert back to what we've expected historically, right?
We're seeing it revert back, and I think we can look back at the time of interest rates being at the zero lower bound as being an aberration in the longer term history. And look, quite frankly, the movement from the zero lower bound to 5% in 10-year treasuries, that was tough.
Yeah.
That was a tough ride.
I'm
not going to sugarcoat in a year. But where we are right now is bonds are giving you a decent income, and they are inversely correlated to equities, which means they are going up in price when equities are going down in price, and it's exactly what you want to see. And I think when Mark and I sort of think about the rebalancing effect, I think it's important to note that the share of equities in household financial assets is at the highest on record. At the highest on record when, in our minds, stocks look expensive, when valuations are high.
Yeah.
At the same time, high-quality bonds are currently out-yielding the forward earnings of S&P 500 and are at the lower end of historical range for household ownership. So you're at this fortunate time period where your earnings yield in a high-quality fixed income portfolio exceeds that of an equity portfolio.
I think a lot of advisors listening, they know this intrinsically to be the case, and for no other reason than, if you started with a more traditional 60-40 allocation 10 years ago, and you've let it ride along the way, especially some of your clients are a little bit more in growth mode and accumulation mode than in managing for sort of a fixed income type of retirement arrangement. Then your equity, you've done a great job on behalf of your clients, and your equity portfolio has done extraordinarily well, and you've worked your way into more of like a 85-15.
That's right.
So I think that probably rings true to a lot of people listening. I think the tricky thing always, and with maybe a little bit of a U.S. hat on, because I don't know how it works everywhere in the world, when it comes time to reallocate, when it comes time to sell, the tax implications of reducing your equity exposure are obviously something that takes a lot of thought, right? Because your basis is low and you've done really well. But putting that aside for the second, the case you're making, that it given vol levels and just given what you can get paid for owning fixed income, and given we're more confident in the inverse price performance and the hedging capabilities of fixed income, it's a time for advisors to be looking at taking some chips off the table. And
I think that's right. I think many of the arguments for taking the chips off the table with equities can be made the same with passive investing as well. There is an inertia component to owning this, and look, it's been a great time to own equities, as you quite rightly stated. It's almost in a monotonic fashion just gone up, and it's been the right call for people to own it. But let's sort of contextualize that against the backdrop of an incredibly conducive environment, both economically and geopolitically.
Right.
And as I said, during that same time period, you can make a very coherent argument that passive investing made sense. You had low volatility, you had QE-driven markets, central banks were telegraphing every move, global cooperation was keeping things stable. In that world, just buying the index or buying the equity index made perfect sense, and it worked very, very well. We're saying that world has gone. But we're not in that world at the moment. In fact, we're trending towards the opposite environment, one of fragmentation, one of policy unpredictability, divergent winners and losers. So I think we should question, is passive investing as safe anymore?
Yeah.
Just buying blindly an index that tells you to buy everything, forces you to buy everything in the index, including the most overexposed and the most overvalued parts to the underlying index. I think if there was ever a time to think about questioning that this is that environment.
Yeah, it's interesting because I think we've always held, the equity markets, the indices for all of the shortcomings that you just alluded to, relatively efficient, structurally reflect the value being ascribed to the individual components by the market. We had Mohit our CIO for Core, on the last episode of the pod. He and I spent about 15 minutes going through passive versus active in fixed income, and just some of the structural weaknesses of the aggregate. It reflects the most indebted companies, not the most valuable companies. It reflects issuance at any given time instead of maybe a longer kind of longitudinal look at debt issuance over time. It simply can't replicate the thousands upon thousands of debt issues that an individual company might have that are floating rate, fixed rate,
That's
5-year, 10-year.
Yeah.
You've got a lot of uneconomic actors involved in the fixed income market, central banks and insurance companies that just have motivations that you or I, as savers, might not have. So let me ask you this: when you think globally,
right?
Because you've got such a phenomenal global perspective. I just talked a lot about the ag. Do you see that pattern repeating in global bond indices as well?
Yeah, we do, and I think if anything, it's more prevalent in global
Really?
bond. Well, because the U.S. has for a long period of time been the deepest capital market, the recipient of all capital flows. So that it's the most efficient capital market as well is highly correlated to the fact that it's the deepest capital market. When you sort of widen the aperture and you think more globally, global bonds and including emerging market bonds as well, I think those inefficiencies that active managers can capture, they really get amplified, and you can really sort of earn your stripes, if you like, on investing in those markets. But all of those comments you made are exactly right. But they've been true for a long period of time. They haven't really changed. But what we're saying is that there is an inflection point now. There is a point that should make you question passive versus active. And that is the change of politics effectively leading economics, a change towards mercantilism, the change towards more of a power-based order versus a rules-based order, which can really violate some of the blind investing theses that have been put out there, the beta-only thesis.
Is one way of thinking about it that the inefficiencies have always been there, but you think that exploiting them is going to be a whole lot more profitable in this new world order we're talking about than in the more repressed regime we've been in?
I think that's right. And, I don't want to talk for Marc, but Marc has been doing this for a whole lot longer than I have. And
is that talking for Marc or against Marc? I don't know what the...
Marc has said he's never been so excited about an active management backdrop. And he's seen many different cycles. And look, I started my career in the early 2000s. I've seen quite a lot of different political cycles and economic cycles. But this by far and away for a macro investor, for an active investor, for one that has a global sense, I think this is by far the best backdrop that we've ever seen.
How, if I were an advisor sitting in front of you right now, how do I get my mindset in the right place to take advantage of what's going on? I mean, the number of topics you and I have touched in this very brief conversation it's mind-boggling. So how do I get ready for what's coming to me?
Look, I think just to say at very high level that the savers are becoming spenders. The spenders continue to spend. We want to position ourselves to capitalize on when there is a transfer of wealth between governments and the private sector. We've seen that very clearly and acutely in the US and what that means for nominal assets like the equity markets. You're starting to see that in Europe and in some parts of emerging markets where military spending is going from 1% to 5% and you're taking on more of government debt across Japan, across Southeast Asia, across some parts of Europe as well. And that's going to benefit the private sector and some of the equity markets there. And you quite rightly alluded to the fact that those equity markets outperformed the US really for the first time last year that we've seen in the best part of a decade. And I think that can sort of continue, not just on the equity side, but also on the fixed income side as well. There's lots of opportunities on the currency markets, on cyclical currencies, on local government bonds, on emerging market credit. Look, this is an environment where status quo, the old playbook, worked really well for the best part of 2 decades. And we think we're moving into a new playbook now. And that playbook is active over passive, it's global over domestic, and it's really thinking about and trying to hedge for those unknowable unknowns that there might be in the portfolio.
Yeah, it's interesting. I think it's important that we be able to sort of break down these themes into component pieces that not just, advisors who are experienced and sophisticated and have no trouble kind of following through the discourse, but their clients who, are successful, phenomenally, gifted professionals, but may not be in finance, right? So can we articulate some of these things in a way that's digestible? And the savers are becoming spenders, and the spenders are becoming saviors. I didn't know where you were going with that, which is interesting. And then to talk about remilitarization in Europe based on an understandable lack of confidence that their security umbrella will be the same that it has been for the last, the post-World War II era. That's a really interesting comment. And I think that would help people get their brains around the idea that we should be looking again at European equity markets. We should be thinking about the differences between global fixed income markets. The other topic you mentioned was Japan, just very briefly, and you dwell on this a little bit in the piece. So I'd sort of ask you, for some of these governments, and I won't exclude the U.S., you mentioned bond vigilantes. So what can go wrong as the savers become spenders, and some people maybe don't want them to become spenders or worry about the level of spending?
Yeah, and Japan was a great example, in the UK before it, of a time where the bond markets have reacted quite negatively to VAT cuts or fiscal profligacy. Japan's an interesting macro example because at the same time that the government's trying to spend more and more money, the stock of government debt to GDP is very high, well north of 200%. The central bank is running quite loose monetary policy as well. Inflation's at 2.9%, and domestic monetary policy is about 75 basis points right now. So you're running quite deeply negative real yields in the front end of the curve. And that sort of sparked a very large sell-off in long-dated government bond yields and the currency. And that led to somewhat of a reversal of policy, a government that's sort of recommitted back to less fiscal profligacy, a rate check in the currency market between the New York Fed and the Bank of Japan, and really highlighting that there are limitations to excess spending. Now, you sort of mentioned the US. We don't think that that's the case yet in the US. We think that the US continues to be the world's reserve currency. We think that the yields that the US harvests, the yields that the US offers, can be harvested by investors. But it's important to understand that one can't run deficits in perpetuity, and that there will be sort of a calling moment for every economy, whether it's advanced economies or in emerging markets. And somewhat the emerging markets are a little bit more used to this because the market reaction function in terms of disciplining the bond vigilantes, as you said, it happens very quickly through emerging markets. And the UK and Japan have seen small instances of similar types of price action. But for the US, we think that the dollar continues to be the world's reserve currency, that there's no sort of questioning of that over time. But I do think that this marginal dollar of reallocation sort of opens a question, not necessarily for the US markets, because it continues to be a deep, large pool of capital. But what happens when you start seeing some reallocation to other markets? And you saw what happened in precious metals this year. You can have 9, 10, 11 standard deviation moves. If you like this, it's sometimes the analogy I use with my 7-year-old daughter is elephants running through a door and things break when that happens. So if you think on the other side of the coin, there's not really a market that can compete with the US in a one-to-one fashion in terms of the depth of that capital markets. Now, you may be in a one-to-many relationship that calls for diversification. We indeed think that we should be thinking more in a multipolarity world where you think about diversification on the portfolios. But it's important to know that things can break on the other side of the ledger.
No, I think it's an important point you're making, and I think it rhymes with some of the things that we hear from Libby Cantrell, who's our public policy head. She reminds us that as much as they're being tested right now, U.S. institutions are very strong. The Fed is a very strong institution. Rich Clarida has also reminded us of that. U.S. markets are strong. Global markets are strong. That what you seem to be describing is an upswing in volatility, an upswing in sector rotation and upswing in maybe the consequences of different geographic decisions about how you allocate capital, but not a breakdown in total predictability for markets, which seems to me like the ideal environment for what you and Marc and the rest of the team here at PIMCO do.
That's right. I mean, we're within our investment committee, we're always trying to sift through noise and signal ratios. And I think this notion of this too shall pass is very important to sort of internalize that a lot of the noise that we're seeing right now is temporary. Now, there are some fundamental breakdowns. There are some changes. I mean, government spending from 1 to 5 is real. And history sort of tells us when you get to 5, it's really hard to go back to 1% again. That means capital will be reallocated in different norms. So if we break out what we think is sort of true structural secular changes in terms of how capital is allocated globally versus domestic, equities versus bonds, passive versus active, we think that those are real sort of tectonic shifts, if you like. But there are noises about, degrading of institutions and within the US in particular, I think that the institutions, as Libby and Rich have commented on, have shown that they've withstood a very, very acute pressure right now and have proven to be strong and resilient. And I think that sort of underpins the investment thesis in the US.
Yeah. So, one of the reasons that Marc couldn't join us is because we were kind of limited in our scheduling ability for today's pod, because you're heading off to Europe in the next day or two, and I believe having an emerging market investment summit while over there. It's not in your piece explicitly, but while we've got you, why don't you can you just give us a sense of how you're thinking about investing in emerging markets? It's not an area, I'll tell you, it's not hugely prevalent for the advisor community in the U.S. as you know, but we've seen a little bit of movement in that direction over the last couple of years. So I'm sure a lot of people listening would be interested to hear what you think.
Yeah, I think it's an exciting time for emerging markets. We're articulating the reasons to sort of invest in EM as being fivefold. Firstly, just from a fundamental perspective, Greg, this is a great backdrop for EM sovereign balance sheets. 2025 was the largest year on record of upgrades to downgrades. We sort of track this ratio, and these upgrade to downgrade cycles, they last about 7 to 10 years. So you're sort of year 1.5 in an upswing cycle. That is the underpinnings of any investment in emerging markets. What is a sovereign balance sheet doing, and how much confidence can I have? And you're right in an upgrade cycle. I think the second point that I'd mention is on inflation. I think emerging markets have really done a great job at a homogenous manner and in a homogenous way, but done a great job in terms of tackling inflation. Now, for the first time on our recorded history, EM inflation, excluding China, because I think it's always important to take China data out of the ledger, but EM inflation, excluding China, now is tracking underneath US inflation. And there was a small aberration in during COVID where US inflation was higher, but sort of that excluded, going back 25 years, we've never really seen that happen. And consistent with that, you're starting to see that being reflected in cross-asset vol markets. So the third reason we would sort of mention is, again, for the first time in the best part of 2.5 decades, EM currency vol is now trading lower in financial markets than that of G7 currency vol. So the EM-DM premium is not being factored from a volatility perspective. And that's hugely important, because if you think about emerging market, the opportunity set, it's risk and reward. It's your reward is the yield you get, the carry that you get, the risk is driven by volatility. And we've seen a collapse in volatility, but we've really seen no change in the yield perspective. So we think it's a great time for advisors to start thinking about emerging markets. And that sort of gets us into the fourth and fifth points. The fourth point I would mention is it's a fundamentally different asset class than the last EM bull cycle. The last EM bull cycle is in 2004 to 2008. That was largely characterized by offshore money. In fact, around 60 cents on every dollar invested in EM was foreign money. The vast majority of that foreign money was retail, not institution. So short-dated, hot money, if you like, type flows going into emerging markets, chasing the commodity cycle back in 04 to 08. Fast forward 20 years to today, it's completely flip reversed. Domestics are the biggest player by a factor of about 70 cents on every dollar now invested in emerging markets comes from the local players. That's important because you're burden sharing with those that have skin in the game in their own markets.
Yeah.
The foreign money that's coming in is largely institutional, and they have a longer duration, a longer time period. So you're seeing the investors that you would like to see being invested in the market actually much more prevalent in this cycle than we saw 20 years ago.
Yeah, that's interesting.
And the final point that I just mentioned, Greg, if I may,
yeah, please.
It's a very underallocated asset class. I go back with a very simple statistic. EMs, whether on PPP or in nominal terms, think about it as characterizing about half of global economic output, half of global GDP. But in terms of portfolio allocations, only about 3% of portfolio allocations. So we think that there is room for that to sort of shift marginally higher. We've been seeing that in terms of our client flows. And we feel it's a really exciting time to look at emerging markets.
That's a really interesting rundown. I mean, I think for most advisors, I think would probably feel that their portfolios grounded in the dollar and domestic investments and reasonable given their clients all live here and spend here. But you've been saying. Dan's been saying, Marc's been saying, over the last couple of years that it pays to broaden our horizons in this new world that we're living in. That's certainly consistent with that thesis. Let me ask you a question that just to hold ourselves to the same standard we're asking advisors to hold themselves to. So when you say expect the unexpected, what is the unexpected thing from our viewpoint that would change your opinion of the attractiveness of the current environment? What are we maybe not putting enough probability on that is out there as a risk that we ought to just be cautious about?
Look, I think it's a great question, and I think we tend to, as a financial community, work on the notion that past is prologue. We run lots of regressions, and the regressions by definition are the past will predict the future or some sort of predictive power to the future.
They take a data set, they look at how it reacts to itself 100%. Going back 40, 50, 60, 80, however long you get the data for.
Exactly.
But they have the common feature that they're all looking backwards.
Exactly. And sort of when you're driving a car looking in the rearview mirror, you're sort of prone to accidents if you like. Look, I think if there is ever a time to sort of question the validity of some of these, now is that time. And I think ex ante going forward, we sort of see that this movement towards more of the macro underpinnings, the fundamental analysis, looking at market technicals, thinking about what can break, analyzing capital flows and to try and see if there's any predictive power on those flows are all things that we as an investment committee are doing. Now, those generally had a lower weighting in the past because you were in this very strong beta environment. You were in this sort of geopolitically stable environment where you could really harvest the power of regressions. As we sort of move towards this newer normal, if you like, or the next normal, we have to question the assumptions of any models, and some models are wrong, some models are very, very wrong, and I think they can be very dangerous if we overweight the past too much.
I would imagine both the volume and the value of debate at the investment committee right now is higher than it's been in a while. I'm sure you guys have you've baseline opinions and outlier opinions, but it's got to be a great crucible for coming up with investment ideas.
It really is, and I think we say this to any young vice president or senior vice president coming into the organization. Try and sit in on our collective forums, our cyclical forums, our secular forums, because the level of discourse and the debate that we're having, and not often coming out to conclusions, just to be fair. I mean, sometimes you're debating them with no end product. And you're not endorsing conclusions, you're endorsing frameworks. And I think for clients right now, that notion of endorsing frameworks like what we've laid out in this piece, it is really really helpful. And when things are in flux and when things are very uncertain, I think we as a collective community want to get together and discuss these sometimes uncomfortable topics to be able to discuss and challenge our priors and challenge the inertia and challenge the regression models and sort of be humble about what we don't know and what is just simply unknowable in markets. And there's a whole heap that's unknowable right now.
Well, I've witnessed any number of those forums in my time here, and I think we're right to pride ourselves on the degree to which they can be uncomfortable and they can result in disagreement and respectful challenging of opinions. We try to hold ourselves to a more accommodating, comfortable environment here on the podcast, but don't let my desire to make you feel good about coming here and joining us. It's not a reflection of how we truly debate important issues here at PIMCO. But Pramol, thank you for taking the time to walk through your latest piece with us. Expect the Unexpected is available at PIMCO.com in the U.S. or our global websites as you choose to visit them in your country. Like I mentioned, it's part of PIMCO Perspectives, which is a quarterly series that Pramol and Marc Seidner put out. We try to feature them each time that they put out one of these really thought-provoking and interesting pieces here on the Accrued Interest podcast. As always, if you enjoyed today's program, we'd really encourage you to like and subscribe to the podcast on Apple Podcasts, Spotify, or wherever you listen to podcasts, and we will be back very soon with another episode. If some of the topics that you heard about today you'd like to go a little bit deeper on, if you come to PIMCO.com and you identify yourself as a financial advisor, you will be taken directly to Advisor Forum. That is our destination for you to get the information you want from us as quickly and practically as you possibly can, so that you can move on with your day and have really intelligent, helpful conversations with your clients. Talk to you soon, and thanks again.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures.